All right, everybody. Ladies and gentlemen, good evening and welcome to us here at ATFX. My name is Philipp and I have once again the pleasure and honor of being your presenter for tonight's webinar. Tonight, we want to talk a little bit about trading. And when it comes to trading, I feel trading is somewhat similar to actually being a pilot. And pilots operate on checklists, and it's pretty much the same thing when it comes to trading, at least for our style of trading. We have to ask several key questions before we actually jump into the market and open a position. And tonight we want to talk about those key questions that I think are really critical and essential to make sure that we have the most out of, or get the most out of our trading operations. Vincenzo is already telling me that the audio and the video are okay. Perfect. Thank you very much. Really appreciate it. Let me just quickly change that first slide here that you see actually that stuff is working on the screen, but I think we have the technical sorted out. So thank you very much, everybody here, for that feedback. And yeah, you already have seen that small questions box. Please, if something is not clear, put your questions into that small questions box. You're not interrupting my flow. It's not that I'm interrupted or intimidated or something like that. No, I'm really looking forward to having that interaction with you guys. Obviously, I know everything that I'm telling you here today already. So my mission is to make sure that you guys understand my message. And if you have any questions, that's perfectly fine. And please ask those questions, and I do my very best to answer those as we move through the webinar. Tonight's webinar is scheduled to run for around about 1 hour. And of course, before we get started, you already do see those first risk disclaimers here on the screen. I have to make you aware of those. So please take a moment of your time to read through those carefully and make sure that you're comfortable with them. Essentially, this says that trading, of course, involves risk. And you should understand those risks and the instruments you are using before you are getting active in the market. As neither ATFX nor Trade with Position nor myself are registered investment advisors, nothing that we say should therefore be considered to be actual investment advice. All examples are shown for educational purpose only. This webinar will be conducted mainly here on the live platform at ATFX, and as a consequence, we will be looking at live market conditions. It's never a trade recommendation. I can only give you guys the opportunity to look inside my head, scary as that might be. I want to explain what I see on those charts, but it's just that, it's just my opinion, and the market couldn't care less about my opinion. If you have this idea that trading is about having only winning trades, and a successful professional trader only has winning trades, this is not how trading works. I can perform my best analysis and still lose 40, 50, 30 out of 100 trades. That's perfectly fine. That's just part of the game. We don't have to win every single trade. So even though I perform my analysis perfectly and think that this is the perfect setup, the most fair of them all, it can still be a losing trade. We have to accept that. And so, because I just tell you tonight that I like a certain market, or I see a certain setup, or that there is something that I'm waiting for to develop, it's just my opinion. I don't have that crystal ball. Nobody has a crystal ball when it comes to trading. And so it's ultimately, you must own your own trades, which means you for yourself must arrive at this idea. I want to open that position because I think that ABC. Somebody, some random guy on the internet telling you that this is a great market to be in, this must never be good enough for you to open your position. You have worked very hard for your money. Capital preservation is the most important thing that we can strive for. And for that very reason, you must own that trade. So once again, it's just for educational purpose. And that being said, without much further ado, let's just jump in. Tonight's agenda, although a trading strategy is essential, there are also some important questions to ask before taking a trade. And pretty much you can say, yes, that strategy is important, but having a precise checklist, just like that pilot in the introduction, to come back to and really check, are all those things, are all those bases covered? Have all those things been considered? That's crucial. And it's very easy when you're in the flow that you think, oh, that's too basic. Of course, I think of all those things. No. It's very easy to cheat on yourself and think you've done all the steps, you've asked yourself all the questions. Why not have that list sitting in front of you? Print a bunch of those and just use a pencil and then really tick the boxes. Have I checked A? Okay. Have I checked B? Okay. Simple as that. Try to create yourself or give yourself a process to follow to and make it as easy as possible. Create the environment that you can use in order to follow that process. Simple example, nothing to do with trading. People have the tendency to drink too little water every day. I'm in that same box, in that same drawer. I drink too little water. So the thing that I changed is every morning I just take my bottle of water and I put it next to me on my desk. And now it's just sitting there. And guess what? If the bottle of water is sitting just next to me, that bottle will be gone by lunchtime. And then there will be another one. But if I have to take a few steps and go somewhere and do something, I won't follow through. So it's very easy for me to create this environment. I just place the bottle next to me and that's it. And it's the same thing with trading. Put that bottle next to you. Put that checklist on a printed sheet of paper just right in front of you. Have the pencil ready sitting there and then really just tick the boxes. Make it as easy as possible for you to follow that process. I'm really big on processes because I feel we need some structure. People always think trading is great because with trading I can totally break free. That's a nice idea, but freedom also requires structures. Freedom also requires having a process to follow through. And maybe you run completely different from me, but the way that I roll, I need some kind of structure. Create that structure, make it easy for you. And tonight we want to think about, okay, what might be 5 of those questions that are fundamental to check before a trade setup? What are things that I really want to consider and understand, which might be easy to be forgotten in the heat of the moment? We want, of course, to do all that live in the market on the charts. So let's just jump in here. And just a quick reminder, guys, if you happen to have any questions, please, by all means, let me know. So here we are, and right now we're looking, just checking, but you should be able to see the charts by now. We're looking here at the euro against the US dollar on an hourly chart. And why did I pick that chart and that market? We have a beautiful downtrend here. We have a well-established downtrend. This is going more towards the trading strategy, and you want to have that strategy. Those are the fundamental boxes that you want to tick. But once everything is setting up here for a nice trade, there are more boxes to check. Those are the topics that we want to cover here today. So just a quick idea, why do I think that this was a beautiful setup here, a beautiful trading opportunity developing and unfolding? Our strategies are trend following strategies, and that means that I want to see a strong trending market. And this is what I can see here on this hourly chart. Price is falling. The euro is getting weaker. Price is coming down consistently and over some longer time period. How do I know that? Because I look at my moving averages and I see that I get this so-called fanning pattern here, which just means the 200 is clearly above the 50, clearly above the 20, and the 10 is clearly below all of them. Compare this with a period like here. I don't precisely know where those moving averages are here. They're all over the place. There is no clear structure. Those time periods can be traded, but they can't be traded reliably with our strategies. It's important to keep in mind that everything that I'm telling you here is something that works for us, for our style of trading, for our way that we want to roll with the markets. Trend following, waiting for an established trend to present ourselves with nice trading opportunities. Not trying to force a trade, not trying to pick tops and bottoms, not trying to chase the market or zero in on range-bound markets and pick the turning points here. I'm pretty sure all of this can be done and can be done successfully. but it's not our cup of tea. We like to see exactly those types of environments, good structures, clear, longer running trends, and then we're waiting for opportunities to follow that trend, wait for a good setup. And such an opportunity was just setting up right here. Yes, price came down, we moved sideways, but the overall structure still was intact. And what we were able to see here is that price was starting to establish a flat level around those price levels here. We can see a touch here, several touches in this area, and finally price started to break here down to the downside. Usually that's the type of setup where I say, nice, this is what I'm looking for. I have my strategy checklists. I can zero in and tell you guys why this is potentially a great trading opportunity. And you might be tempted to say, all right, let's just trade that setup. But obviously something was not quite right. And we can see what happened next here. Suddenly we start to see those candles getting pretty large, and we start to get wild volatility swings. What was or what has happened here? And why were we able to anticipate that something like that might be happening? And this is something where I say, okay, the setup is nice and sweet, but I know something is up and it's just not worth the risk. So quick question, guys. What do you think might have been the reason here? Euro against the US dollar, and this was pretty much here going into the morning session here, beginning of the London session. Quick idea, what might have been going on there? Just waiting a few moments here for your answers. Absolutely, yeah. Volatility coming into the market. Vincenzo is saying news increased volatility, and Warren nailed it. It's the ECB, it's the European Central Bank. And sure enough, Mr. Draghi was once again printing money, or intended to print even more money. And how did we know that something like this was up? We can easily visit our ATFX homepage here. And in the analysis section, you have the economic calendar. And what I like to do at the beginning of my Forex trading day, I want to log onto that website and I want to check which are the scheduled news events, what is about to happen. And sure enough, I see that at 7:45, the ECB is getting active. Interest rate decision July, monetary policy statement, lending facility, deposit facility rate, and so on. The importance of those messages is, or the potential to move the market is here indicated with either 1 to 3 bullheads. Not bullets, but bullheads. Yeah, okay. Sorry, guys. I want to see if I have this idea that the market might be moving big time. And usually if it's 2 out of 3 or 3 out of 3, that's for me that I say, all right, I want to be aware of that. And usually I want to stay on the sidelines. Either I have a trading position on, which is on such a short time frame. If this, for example, here had not been an hourly chart, but rather a 5-minute chart, and I could have easily anticipated that this trade should be over in about an hour time, and we have few more hours ahead for that ECB meeting and the news releases to start, then that would have been potentially okay. But when this news is about to hit the wire, I want to be out of that market, because here you can beautifully see what happens, and this pretty much happens all the time with those news events. You see just volatility spiking. You might have this idea, I picked the right direction. I have a macroeconomic model and I can assume I know what's going to happen. That's not good enough. It's not good enough because it's not about what the ECB decides, but rather what is the reaction of the market to that decision. That's the really important thing here. And the other thing is you can see that volatility spikes and the price moves in both directions. So even if you said, I feel that the market might be going higher, yeah, guess what? It went higher, but in the beginning it spiked against you, against that trade in the original direction of the trend here. It spiked down big time. You have huge swings usually in both directions. And this is something that you don't want to have. Why don't you want to have that? Because with proper trading comes proper risk management. You want to have a stop loss in place. I want to have a real stop loss placed with my broker. If you say, no, I don't want to show my hand and let the market know where my stop loss is, I'd rather have a mental stop loss, that's perfectly fine if you're able to act upon it. I tried that for myself, and I'm not ashamed to tell you guys, it didn't work for me. My psychology, my mental game was just not strong enough at that point. I'm sitting in front of the screen, I see that price goes against me, and I know that I should push the button, but then I'm a little bit too late, and price already went beyond my stop loss level. And so suddenly I start to think, wait a minute, it will come back. Guess what? It doesn't come back. And usually this is where just another normal losing trade pretty quickly turns into something quite horrible. And I did this exercise a few times. And then finally I said, Philip, this doesn't work for you that way. I've had enough. I've had it. And since then, I just submit my stop loss order. Easily done here on the MetaTrader platform with an attached stop loss and take profit order bracket. And that's it. I know that my stop loss is in place and I can take care of good proper risk management. Let's just assume that you think that the market might be going higher and that you want to have a stop loss in place. And so a logical place for that stop loss might have been sitting here just below this swing point low. And you think, yeah, market is going higher, profit target somewhere here. And guess what? Yes, market is moving your direction and then bam, you're being stopped out. And ultimately, price hits your profit target. But that doesn't matter because you're out of that position. It's freaking hard to apply proper position sizing and stop management in those volatility spiking news scenarios. And at the end of the day, at least for me, it's just not worth it. It's just not worth it. I'm happy to sit on the sidelines here. Yes, this would have been a nice trading opportunity, but no, it's just not worth the risk. And guess what? My trade would have been a short trade here, obviously, and maybe I would have gotten here my first profit target on the short side, but most definitely I would have been stopped out here on the remaining part of the order or the complete position. And I just knew that big news was in the pipeline and it's just not worth the risk. Same thing is true with the Euro financial crisis and the bailout for Greece. Back in the day, I made absolutely sure that I won't have any open Forex positions over the weekend. I was double and triple checking that I had closed all positions Friday evening, no positions over the weekend. This is just one bad tweet from a prime minister or a chancellor or I don't know whom. And this one bad tweet can take care of that market opening somewhere completely else on Monday. And it's a world of pain. You don't want to have that. So always be aware of the news environment and of the risk that is about to, or that is inherently there with those news events happening. Do we know all the news up front? Absolutely not. But there is a fair part of, there's a schedule of those news events. And so once again, make it a habit to check in the morning, okay, what are the news events for today? Which markets am I interested in? When is the press conference? What's going on there? non-farm payroll numbers in the United States, for example, interest rate decisions, always big things. Let's look at what's in the pipeline for tomorrow. Russian ruble interest rate decisions. All right, not sure that this is so big moving if you're not really investing in the ruble there. But apart from that, gross domestic product for the United States, all right. So all this is apart from the GDP, it's just two-star news events. Nothing really where I say, all right, I'm worried that something big might be happening. Can always be the case, but given that schedule for tomorrow, it's rather unlikely. So that's first thing that I always want to check. I don't see this on the chart. I have to check and be aware what is the news situation. If you're looking into stock trading, for example, guys, be aware of those earnings numbers and earnings releases. When are earnings about to be announced? Yesterday, just Tesla. World of pain. You don't want to have that risk. You don't want to take that position. First, no, it's not about guessing the proper direction. It's not about the direction. It's about the reaction of the market, and then still it can swing in both both ways, in both directions. It's just not something that you can easily plan for and account for. And if I can't control a situation, usually I don't want to be in that situation. So stay on the sidelines. So number one, always check the news. Let's talk about this setup, however, a little bit more here, because the big idea is, why do I think that this was a potential trading opportunity disregarding the new situation? I have those fancy lines here on my screen. And what are those fancy lines? Those fancy lines are support and resistance. And I'm always going here for a flat horizontal line of support and resistance. I do not care about those sloping trend lines. I feel they are always rather subjective to draw, and they're not really that actionable. The quality, the signal quality is not as good as with the horizontal lines. And there's also an operational downside. As those lines are sloping, I have to adjust my orders pretty much every new bar that is showing on that chart, because the price level obviously varies with a sloping line. With a horizontal line, this line is just there and it's just working nicely. And here, I just put that line on the chart and I just grab it and drag it around, and I see where it sticks. I want to see that price has reacted to this level a few times, and reaction here, closing counter there and there again, and finally it goes to the downside. If there wasn't that news event pending, that would have been a very nice setup. Easy to spot using those horizontal lines of support and resistance. And support and resistance is really something big that you want to see. We're switching here to another market. This time it's gold against the US dollar. And if we just go here to a weekly chart, you start to see that price reacts to those levels several times repeatedly, and you want to be aware of that. So if you think price is about to just push higher here, and there might be, once again, we have our fanning pattern here. Price is shooting higher. It's pulling back to our moving average buy zone. So would those have been here nice buying opportunities? No, they weren't. Why? Because I just know that this level of support resistance is sitting there. I know it's just like an X-ray of the market. I just see that zone of resistance here. And can price break through? Sure it can. That's exactly what happened here. However, is it likely to break through here at this time? No, the risk is too high for me. So I want to be aware of support and resistance levels, and I want to be aware of those support resistance levels, not only looking at an hourly chart and seeing what's going on there. No, I'm interested also in the big picture. You can start to see that this price level here is going back in time for quite some time. Price has reacted to those levels in the past. What's going on there? Why is price behaving like that? Price is not behaving in any way. Price is not something that is given to us by the gods. Price is just something that we can observe and that we can track. But price is not the original source. Price is just the observable result of people acting and trading in the markets. And if people think that at that point in time here, buyers were becoming reluctant and felt that maybe let's play this a little bit safer. Let's stop down with our buying. And sellers were more aggressive and said, wait a minute, I'm not sure that I can get a better price for that. Rather start to sell, rather start to hit the bid than trying to go for a few dollars, a few cents more here. So people had ideas, people had emotions, people had an agenda of why they wanted to sell at that point in time. And guess what? Those very same people, when price approached this level again, probably those same ideas ran through their heads once more. And this time people realized, other people realized, wait a minute, major market participants had been selling the market here. They started to sell the market again here. And once again, prices approaching the same level. What happened in the past at this price level? People were selling. Oh, wait a minute. So maybe we should become reluctant here to buy and rather start selling as well. So it's not that price is just coming out of nowhere. Price is just the observable result of people acting in the markets. And for that very reason, it's very easy to spot those levels of support and resistance. And we can easily use those. And please, not just focus on the time frame that you intend to trade. I'm not sure. Could have been that this on the 5-minute chart was a killer trade setup. But stepping back, getting that bird's eye view down from the monthly chart, from a weekly chart, even from a daily chart, would have easily shown you, wait a minute, this is not the perfect setup because there is just so much support resistance ahead. And guys, I'm always using this term support resistance in one word because honestly, I don't care. I just know there's a line and price has to push through this line. And this takes some effort. And the more often price was not able to push through this line, but respected that line, the more important this line probably is. The nice thing is, here it's now acting as resistance. Price has to push through. It takes some effort. But when price finally broke through this line here, does this mean I can remove those lines now? No, because support turns into resistance and resistance turns into support. Why is that the case? Well, people have been selling the market at those price points here all the time. And now the big idea might be that people could still try to sell this market here at this price point when price approached this point here once again. The previous candle here was not so bullish after all. Let's make this a little bit larger. This candle here, the structure is rather indecisive. Upper shadow and lower shadow pretty much have the same length. Small body, yes, it's a bullish body, it's a white body, but it's sitting right in the range and not that bullish. And so you might think when price approached this level, this point here again, that they started to sell again. Now, the thing is, everybody who has sold that market at that point, as they did in the past, and in the past it worked like a charm, but this time it hasn't worked. They are now short. They are now short, price pushed higher, they are in a losing position. What's the battle cry of the losing trader? I will get out once I break even. So that short seller here has to buy at some point. And where is this break even happening for him? The moment price pulls back to this level, this time from the upside, there he's breaking even. There he wants to close this position. He wants to end the pain in which he is right now. And therefore, when price is approaching this line from above, those short sellers will start buying. And this is why price probably will bounce off this line. That's a very common pattern that you want to see, that you see quite often. Price is pushing through a line of support resistance. It's coming back to test this line once again from the other side, and then quite often bounces off that line and proceeds in the original direction of this new form trend. And for me, this is just this idea, what's been going on there, the mental game of why people have been buying, and yeah, what drove them. Another good comment here, some indicators also show market profiles with point of control points, control prices, very useful. Two things here. First, a little bit more. First of all, yes, I completely share your belief that those market profiles are truly fascinating. Full disclaimer, I'm far from being an expert on those, but I feel that they usually can help us, and they bring something new to the table. Now, it's important to understand those market profiles can be created in two different ways. The first way to create market profiles is how much time does price spend within a certain price range. And the other approach, which I feel might have a little bit more merit to it, is how much volume was traded within a certain price range. And so we have two profiles. One is a time-based profile, and the other one is a volume-based profile. The bad thing with volume-based profiles, however, is they really work just precisely because they have good data there on stock exchanges, on futures exchanges, and so on. With Forex, you have not that one centralized marketplace with solid, reliable volume data, but Forex is a network of big corporations, big banks, market participants, brokers, and so on. And as you don't have that one centralized marketplace, you don't get precise volume data. You can get some volume data, but this is always just some kind of snapshot of a really small subset of all the trading that occurred. And for that reason, I feel that those volume profiles have to be taken with a grain of salt, at least when it comes to Forex trading. What different points are available? What data points can be used when it comes to technical analysis? First of all, price. And everything that we do here is pretty much based on price. Price is observable. Price is what's people acted at those price levels. And so price really, truly is important. No doubt about it. And price is available for all markets. The next thing that is really important and can be used because it adds really a true new dimension. Indicators just use price action. They perform some magical calculations, but it's just price going in, and therefore it's always just price-based data coming out. Indicators can never, ever add something new to the table. They illustrate and highlight certain aspects of price behavior, but they can't create new information. Really critical idea when somebody tells you they have the latest and greatest indicator. The only thing that this indicator can do is highlight aspects of price action, but it's all within price action on its own. Learn to read price action, learn to read those candlesticks. The second point that is really independent, new information, is how much volume occurred. How much volume was done, especially when it comes to stocks trading. Absolutely critical. If you add those volume data on top of it, suddenly some breakouts look rather weak because no volume backed them up. Other breakouts, they occurred on huge volume, 3 times, 4 times the usual volume in those areas. And therefore, yeah, obviously that breakout has to be more important than the other ones. So if volume data is available, please, by all means, use it. It's adding really new additional information. It brings something new to the table. And the third thing, which is rather interesting, but unfortunately is also only available on a few markets like stocks and futures, is where did the trading occur? Did the trade go off on the bid side or on the ask side? Because this interesting thing here is who was more eager to push the button? Who was more eager to do that trade? If all the trading occurs at the bid, then usually sellers are pretty aggressive. So that level of aggressiveness can also be seen by looking if that trade went on at the bid or at the ask. If everybody is in a bull run and everybody's buying like crazy, buyers probably won't be sitting there and saying, yeah, I'm willing to pay my price X and I will let the sellers come to me. No, everybody is just chasing the market. And if you see a ton of trades going off at the ask, yeah, sure enough, this is mass psychology and people trying to chase that market. So 3 different data points, 3 different, really different information that can be used for our analysis: price, volume, and if the trade went off at the bid or the ask. Those 3 things. For all markets, unfortunately, we just have price data. But very good point, and by all means, guys, keep an open mind. Just because I tell you here a lot about price data and price action, many cool things are out there which we don't teach here. Just keep an open mind. Be critical and ask yourself, how does this add something, or what does it bring to the table? But so many cool things out there to learn and to discover. And yeah, market profiles, absolutely part of them. And bid ask, the keyword here will of course be footprint charts, and based on those footprints, way beyond the scope here and not applicable for all markets, but those are the 3 major data points that can be used for trading. Price is available for all markets, and this is why we want to focus on price here first. We have seen now that reason why people probably why people which were on the wrong side of the trade could be starting to buy this market once we pull back towards this level. And that's really a common pattern. We get the breakout, we come back to test this level once again, and finally move in the original direction of the trend. So we talked about news, we talked about support and resistance. Another critical point is people very often just focus on the time frame that they intend to trade. And let's just talk about this gold chart here. This is completely random. What is the trend on this chart? The trend on this chart here was for quite some time a downtrend. Why? Because we saw lower highs and lower lows. And talking about lower lows, this is just pretty much screaming at you to say, where is here a level somewhere? Some reactions here and there, not a perfect level, but something's going on there. Another thing, I feel that this is a better level. Does the level usually should touch the end of the shadows, or should it go the end of the body? I feel that the end of the shadows is way more important, because that's really the ultimate turning point and price trade. That asset traded at that price, and for that reason it's there. And so we have closing counter here and there and there, and this candle here with the body works for me. Usually I want to see it like that the end of the shadows define that line. And pretty much the same thing that we discussed here before with the Euro US dollar setup. I see a downtrend. I see a well-established downtrend which has been going on for some time here. I see a flat level, I see pressure building up, and finally when we get the breakout here, the candles are getting smaller, and suddenly pressure is being released. We get the breakout and candles become larger again and pulling back here. What is the trend? Well, the trend here is a downtrend. Does this mean gold is in a downtrend? Absolutely not. Gold on the 5-minute chart was in a downtrend. What is the time frame that I intend to trade? I intended to trade the 5-minute chart. All right, but this is not good enough for me. I want to build a case. I want to explain why I feel that gold just has to go down in price. And just relying on this one perspective here is not good enough for me. I want to get a different opinion. I want to see another doctor. I want to get another diagnosis. So I'm looking not at a 5-minute chart, but I'm looking now at a 15-minute chart. What is the 15-minute chart telling me here? Well, we have been in a downtrend, clearly lower lows and lower highs. I see the fanning pattern here, and I see that price is pulling back. We're sitting here close to a moving average sell zone. So the 15-minute chart is telling me, yes, this is also a downtrend. And if you want to sell short this market, I can understand that, and I back up that idea. So the 15-minute chart also giving me this idea that the market is going down and a short trade might be a good idea. What about the 30-minute chart? Pretty much the same story. We are a wee bit overextended here from that from our moving average sell zone. However, overall, same story. Yes, this market is going down. So I have now the time frame that I intend to trade, the next higher time frame, and the next higher time frame. And they all tell me the same story. Yes, I'm currently trending down. I compare this scenario with that Scotland Yard inspector arriving at the crime scene, and he's a lucky guy because there are several witnesses. And he's starting to interview the witnesses and asks them, what is it that you saw? Can you describe what happened? And so witness 1 tells him a story. And if witness number 2 tells him the same story, and witness number 3 also the same story, then suddenly he starts to get a pretty precise picture about what actually happened and whom he should be looking for. However, if everybody is telling a different story, if one guy tells him that the suspect left the crime scene in an Aston Martin, the next one was sure it was a Jaguar, and the next one said, no, of course it was a Mercedes, and the colors range from yellow over black to red. Good luck finding that guy. Or was it a girl? I want to have a precise story. I want to know precisely what's going on. And hourly chart, even the hourly chart is telling me price is going down. It's just when I arrive here at the daily chart that I say, wait a minute, the overall picture here is an uptrend. So this is not in line. However, I can still use the daily chart and say, yes, but we have been overextended here and we're currently in that retracement. We're currently in that pullback. And therefore, even though the trend on the daily chart is an uptrend, I can still understand that we are currently pulling back. So this counter trend trade on this daily chart makes sense. Would I like to do a counter trend trade here on the daily chart? No, but if I see that the 5-minute chart is giving me a potential trading opportunity, and I have every other time frame up to, let's have a look at the 4-hour chart. Yeah, the 4-hour chart pretty much is all over the place. I wouldn't trade based on that 4-hour chart. I hope you can see that. That 4-hour chart here is just, it's a mess. It's no clear trending structure. It's not really clear what's going on here. But the hourly chart, yeah, we have a trend. Yes, trend, all pointing in those same directions at that point in time. So I can build a solid case. I like this storytelling idea. I want to tell a story about why this market is going in a certain direction. And a key component for that is having multiple perspectives, having multiple trends, hopefully all going in the same direction. Because once again, gold doesn't have that one trend. Gold on a monthly chart has a trend. Gold on a daily chart might have a trend. You want to see that those different time frames tell you that same story. You want to tell a consistent story about why that trade setup is a good one and why you're looking for that. So key component here, and always check that. Don't get just lured into that trading opportunity and say, everything's nice, I have to trade this. No, take the time. Check the next higher time frame, the next higher time frame, and so on. All this must come together, and only then is it that you say, all right, now I want to pull the trigger and trade that setup. And by the way, guys, potential trading opportunity, again, just educational purpose, it's not a recommendation. What is it that we see here? Price is making a downtrend, fanning structure in those moving averages, lower lows and lower highs. We have now just pulled back here. Where did we pull back to? We pulled back to our moving average sell zone defined by the 10 and 20 period moving average. What is it that we see here? We see currently a still rather smallish bearish candle setting up here at the very close to a moving average sell zone. How could this be tradable? And guys, once again, not a recommendation. This is just now for educational purposes. We will have to check multiple things here. If that was the end of this candle, I always wait for this candle to finish printing. This candle is still going for, it's a 30-minute candle, which means this candle will still go for 14 minutes. I know that it's tempting to say, oh, I have to jump in. No, the structure of this candle can still change 5 seconds before the hour. Don't do it. I think I didn't have to wait. I paid the price for it. Please don't pay yourself. I paid already for both of us. Always wait to base on we want to see finished candles. Now, let's just assume the candle was already done. My entry, I would be entering here with a sell stop order below the low of this candle, and my stop loss would be above the swing point high, and therefore my stop loss would be sitting here. Is this a great trading opportunity right now? Not sure, I have to check other things, but let's just focus here on a risk-reward perspective, which is also a crucial thing to understand and to note and to check as a key question. How good is that trading opportunity here with regard to reward to risk? What's the risk on that trade? Well, I'm entering here on this line and I'm closing with a stop loss right there. So this distance is my risk. With my position sizing, I now have to take care that if I'm triggered in here and being stopped out there, that the amount of lots that I intend to trade, that this distance here should be good for about 1% of my account size. 10,000 pound account, I'm willing to risk 1%, which means I'm willing to risk 100 pounds on that trade. So I must trade so many lots that if I'm triggered in here and being stopped out there, that around about 100 pounds are gone. That's position sizing, but let's focus about the reward to risk ratio here. If this distance here is my risk, where is my reward? Well, my reward is where I intend to close that position. And let's get rid of this one line here with our level. Yeah, that was the wrong one. Sorry, guys. I'm entering here. I'm being stopped out there. So that's my risk. And this means that I go for a 1-to-1 reward to risk ratio, just eyeballing it, assuming that this distance here should be the same. This is a 1-to-1 reward to risk ratio. I'm risking this much in order to make that much, 1-to-1. And this is probably fine. We have two components to become wealthy as traders. We must have a strategy that gives us an edge. And this edge means we hopefully win more trades than we will lose and have to pay for. We can't do away with those losing trades. Doesn't work like that. We will always have to pay the piper. The only thing that we can do is stack odds in our favor, perform technical analysis, tell great stories, and arrive at those great stories and conclusions why this is a potentially good trading opportunity. And this results in winning more often than losing. If we win 55 out of 100 trades, this still means that we have to have still 45 losing trades, which is absolutely not funny. But it doesn't matter because we win more often than we lose, and this means we should be able to make money. We will make money if we win exactly as much on those winning trades as we lose on the losing trades per trade. So this means we just lost 45 pounds, but we just won 55 pounds if our risk per trade is £1, which means after 100 trades, we should be able to come out ahead around about £10. But we can go for something else on top of it. We don't have to go for a 1-to-1 reward to risk ratio. We could be going for multiples. We could be going for a 2-to-1, 3-to-1. We could be going for a 1.5-to-1 reward to risk ratio. And that's a crucial thing here to understand. The larger the distance is between my entry and my stop loss location, the more price will have to travel in order to give me my 1-to-1. So that candle, that setup here is already more on the largish size, if you want to put it like that. If that candle was smaller and, for example, it would have been possible for me to enter here and leaving my stop there, then suddenly that's my risk. I can now take a larger position because smaller distance, I can take more lots, more contracts on to still have my 1% account size risk, my £100 risk here. And if I'm now shooting for that same profit target, suddenly I'm no longer going for a 1-to-1, but this should be now something closer to maybe 3-to-1, which means I can still lose 45 trades, but on the 55, and I will lose £1 or £100 on those trades. But on the 55 trades out of 100, which I will statistically win, I now will not win £100, but I might be winning now 200 or 300 pounds per trade. That's the second component. We want to win more often than we lose, and we want to win larger. And this is how we make money, and this is how we can finally accept that having losing trades is just part of the business, and it's just part of the game. It's just like paying the phone bill, or we have to have those losing trades. It's just something that can't be avoided. Think and pay attention to the reward to risk ratio. Usually what our psychology and our mindset leads us to do is to say, all right, I can go for this setup here and great times. I'm already running a profit. It's so nice. I have a profit. I have a profit here. And then you start to close that trade. You close that position because we all know nobody has ever gone broke taking a profit, right? But you're just cheating yourself here because right now you have risked £100 for the opportunity to make maybe £20. That's a bad bet. Risking 100 in order to make 20. No, we want to make more when we win, and we want to win more often than we lose. So always pay attention to the risk reward ratio on those trades and the setup that you see here. One side note, what I always like to see is that my 1-to-1 reward to risk ratio should be, in this type of setup, should be reachable without the need for the market to make a new lower low in this downtrend. So if my entry was here, then suddenly I would have to see a price target of round about here just to get my 1-to-1, and this is below the old low. Yes, it's a downtrend. Yes, I think that it's likely that price will be able to make this new lower low. But I feel that even if the trend is coming to an end here, we might still be pushing towards that low. Will we make that low, or will we make a new lower low? I don't know. But I feel that a retest of this old low is way more likely than going for a new actual lower low. I hope this makes sense. I want to hit my first and preferably also my second profit target on a way within that range of that retracement. If great things have to happen in order for me to make a profit, I, I want my trading to be boring. I'm not looking for excitement. I'm looking for money. And boring wins for me every single day. Boring is, I can have my excitement somewhere else. When it comes to trading, I prefer boring. And I don't want to depend on huge moves in the market. No, no, no. Small move, grinding all that, and make sure that you get, it's a game of inches, something like that. So keep that in mind. All right, let me have a look at my checklist here. Another critical thing to keep in mind is also the general market direction, the big picture. We talked about time frames, we talked about support and resistance, news, reward to risk ratio, and also about the big picture. And the one index that I like to look at when it comes to the general health of the economy and the market, and I know with all this quantitative easing and so on, it's a really tough thing to use an index like the S&P 500 as a health indicator, because I feel that the stock market and all the money printing has pretty much detached and decoupled what's happening in the markets with what's happening in the general economy. Here in Germany, we do have the IFO Institute, and they run that's a university-based entity, and they run surveys asking leaders in the economy and business how happy are they and how confident are they in the prosperity and well-being of the market. And those numbers came back today, I think it was today, and they were pretty dark. And even Mr. Draghi said that everything is going down the drain, and therefore he has to print more money. And so, yeah, I don't feel that those all-time highs in the S&P 500 are really a good indicator of how good and strong is the market. However, if you're looking into trading the US economy, and with Forex, pretty much everything is connected to those markets. I like to look at the big picture, and this is for me always the S&P 500. You see the big picture here. Let's go to the monthly chart here. Beautiful uptrend going strong all the way, and all those rather scary pullbacks here towards the beginning of this year, end of last year, and then in between. Those are just mere setbacks, mere pullbacks. You see here on that scale, this was just really a 38.2% retracement at that point in time. Not really something scary going on there in those markets. What's important to note, however, is the volatility definitely has been increasing. And when we see that the market is shooting for new higher highs here, one thing to note and pay attention to is that we're clearly starting to see divergence here in MACD and also in RSI, casting again a little bit of warning signs. You can think of this divergence scanning as some kind of X-ray. Yes, we see new higher highs in price, but is it really that healthy? Is it really that strong a market environment? At the all-time highs, price is now just starting to pull back, and I don't want to do a political commentary here, neither on the European situation, nor on Brexit, nor on the White House in the United States. I feel everybody has enough information to make up their own minds here. It's just Somebody told me that that the proper name in English here is that game of musical chairs, and currently the music is still playing, and we will have to see how long that music still plays. So far, this is looking nice. A little bit of warning signs here ahead, but the big picture here is still, yeah, the economy is doing great. At least the stock market is doing great. I'm not so sure about the economy. So let's do a quick recap here of those key things that I like to watch and analyze when I want to double and triple check my trading decisions. I want to look at multiple time frames. Those multiple time frames are important. Think of those witnesses, and as the more witnesses describe what's been going on, the more likely it is that you have a consistent and congruent picture of what the market is doing. Second thing, support and resistance levels, not just on the time frame that you intend to trade, but try to get the big picture, zoom out, go to higher time frames, see where those key levels are, and don't be afraid to consider prices going back to 2000 or even the 1900s. Nothing wrong with those. People acted there, people pay attention to those levels. Basic, easy technique to use and to analyze those markets. Use support and resistance levels. We talked now also about the general market, getting an idea of what the big picture is, what's been going on there. Have a look also maybe at the treasury products there, interest rates. See if the inversion of the yield curve is consistent, or if that is returning to a somewhat more normal structure again. Pay attention to news. Have a look at this economic calendar and at least those news events which are rather likely to move the market. Try to stay out of those markets around those news events. And finally, talking about reward to risk ratio, make sure that your trade really has potential to properly reward you for that risk that you have to take. You take the risk the moment you open that position. Make sure that the market is giving you enough potential, at least, to pay for that risk. All right, guys, so that's pretty much a wrap at that point. Let me just quickly finish that presentation here. Tonight's presentation, of course, was brought to you by ATFX, and so if you haven't opened that account yet, the question might be, why would you consider ATFX as your broker? You want to have a good, solid business partner. ATFX are regulated by the FCA. You see the license number here. All those are just steps to make sure that you have a good and solid business partner. Account segregation, nobody's able to run off with your money, and the company will still be around tomorrow. Sounds rather obvious, but depending on where your broker is located, unfortunately, it's not always so clear and well defined. And here, with the regulation by the FCA, at least you've taken a good security step here to make sure that that you can focus on your trading and not be worried about your market access provider. If you haven't opened that account yet and still have questions, here are different ways to be in touch with ATFX. Give them a call, write them an email. They're more than happy to answer and answer your questions there and help you to get started with your trading. Talking about getting started with your trading, if you have any questions still now, I'm very happy to answer those questions. And if not, then that would be a wrap for tonight. Thank you very much for tuning in. I hope you enjoyed today's session. You learned something new. I think that there's a survey coming up at the end of the webinar. And yeah, any feedback that you have for us is really appreciated. We're running those sessions for you. And for that reason, yeah, tell us how we can improve, where we can improve. What is it that you liked? What is it that would be so awesome if we covered that the next time? More than happy to give you guys the content that you came here for. All right, we seem to be good. So yeah, thank you very much for tuning in. A very nice evening, happy trading, and looking forward to catching you guys next time. Thanks again, take care, and bye-bye.